Hey, thank you for tuning in the Inquisitive Minds Podcast. I'm your host as usual. My next guest is a financial crimes consultant, Dave Specht. Dave has a bachelor's in political science with on international relations and business at Kent State University, class of 2012. He sold mortgages for a little over 2 years, left mortgages to move to Cleveland, where he became an anti-money laundering consultant, focusing on helping banks get out of regulatory issues when dealing with lapses in their AML compliance programs. Now he works in-house for a not-to-be-disclosed bank as a department officer doing similar work. Welcome to the program, Dave. How are you?
I'm doing well. Thank you for having me on today. It's funny that we set this up weeks ago and now we're here.
Yeah, it's a great time, especially with everything going on. I guess let's jump right into it. There's a lot of talk going on with GameStop stock prices and market manipulation. I don't understand too much about the stock market. Can you break this all down for us?
Certainly. So what happens is you see a bunch of like hedge funds. And what they do is they necessarily do what they call like stock options. And what they are doing is they're necessarily shorting the stock. So what they do is they essentially then they will take like GameStop stock, and what they'll do is like say GameStop is at $12 a share. They will sell those shares at $12 on like a loan. So like, like say you own GameStop shares. A hedge fund then can go to your brokerage and they can go in and say, hey, we want to borrow some clients GameStop shares. They sell it at $12, expecting the price to drop. So then when the price then drops to $8, they then trigger that option, and they split the difference. So then they pay back the stock at $4 back to the broker, or back to $8 of accept, and then they pocket that $4. So they split 12, but then they paid back the loan at $8 a share. So that's essentially what a shorting of the stock is. So that's kind of what those, that's kind of what was happening here with the GameStop. And, these hedge funds are, they're smart, and, they look at these fundamentals, and let, everybody be honest, the new PlayStation 5, for instance, the top selling model is the one without a disc. We're going to a discless future where GameStop is like an obsolete company. So it only made sense for them to kind of short the stock. A bunch of people on the Reddit, and there's been a huge phenomenon in 2020 especially. So you've seen Robinhood emerge as like a place where you don't have to pay fees to buy and sell stock. And so there was like kind of like a race to the bottom over several years. I don't know if you remember growing up in like the late 90s, early 2000s. There was like Scottrade and TD Ameritrade and all these like online brokerages where you could, buy and sell stock.
I remember some of it. But in the late 90s, I was still pretty young. The first one I think I can remember was E-Trade.
Yep, that's one of them. So it used to be like when you bought and sold stock, you would there's been this like huge evolution in the stock market. It used to be you would buy a stock like, General Motors or like General Electric or like Radio Corporation of America back in like the 40s and the 50s, and that you would get paid dividend. You would get paid, a dividend out on that stock. And, there's still dividend plays still in the market where you get shares, when you buy. So, there's always that in the market, and that was like the precursor, like that was basically the intent of the stock market. And then that kind of changed, with the emergence of these online platforms, and it started driving a race to the bottom, because it used to be like $100 you would pay a stockbroker to buy and sell shares in the stocks. So there wasn't this high frequency buying and selling, back in the day, like back in our grandparents' generation. And then in the 90s, late 90s, early 2000s, it started this race to the bottom. Go ahead. I'm sorry.
I was always under the impression too that when you bought stocks, you had to buy an actual stock, like one or an actual multiple. But now I guess you can buy parts of a stock and pieces of a stock.
Correct. And Robinhood and that's a great thing that you mentioned that, because like Robinhood was actually the pioneer in that. They were the first brokerage that said, okay, we know Apple stocks at 1,400 a share. Like, the average, small person that's like small time, middle class, working class person that's like, hey, I know our dollar's being devalued. I need to start putting money away in like assets, so that way I'm getting, when this inflation bomb hits, and we can talk about that in a little bit later. When this inflationary bomb hits, I'm getting some money. My money's growing in the stock market because it's an inflation hedge, and so I can, I'm working, and I'm making. Say you're an average guy making like 45,000 a year. You're not working class, but you're not, right up there in the middle class. But that and prices are starting to go up and creep up. We had oil trade negative territory this past summer, but it's still $2.50 a share, and that's because they keep printing more money. So but you've seen these phenomena now where, and Robinhood was the first like fintech, app to basically facilitate, people making 40, 50,000 a year to be able to buy stock in like big companies like Tesla and, Netflix and things like that. And, these retail investors have really started a revolution here with all this, because, if you look at the fundamentals of Netflix or like a Tesla, their bonds are trading in junk territory, meaning that Wall Street and the bond rating agencies said that these are very risky debts because they have so much debt that these companies have taken on. But the retail investors are saying, hey, streaming's the future, electric cars are the future. So, we know that, these debt problems will be solved in, the next 5-10 years, when these revolutions, theaters are dying out, people are streaming at home, electric cars are the future. We're trying to
Yeah,
move from a
absolutely.
fossil fuel world. So even though that the Tesla and Netflix fundamentals didn't start, people at 40, 50,000 a year could see the future, because they're ingrained with it. They love Netflix, and the people that are lucky enough to afford Tesla, they're rabid loyalists to the brand. So they pumped a bunch of money into these stocks, and they drove them through the roof. And they, a lot of these investors only own partial. They don't own the full, they don't only own a full share of the stock. And that's really
let me
enabled a whole
stop
floor.
you for a second.
Okay.
Let me stop you for a second, because I don't know if it's just my lack of intellect, because every now and then I consider myself a smart fella, and then I'll meet someone who I have a conversation with, and I clearly see I'm outclassed. And that's one of the conversations here. So I might have to stop you just to follow you.
No,
so
that's
with GameStop, in order to drive up the prices of the stock, they just had a bunch of people buy it.
Yes. So what happened is that, GameStop has recently tried to like change their business model and focus more on e-commerce and getting games out for delivery for, the average people, because, with COVID things, it's really, that whole that retail death cycle has really accelerated. So, and then, like I said, some of these newer consoles don't even have disk drives on them. So, the physical media, which GameStop specializes in, is kind of going away. So a bunch of these hedge funds came in, and they started shorting the stock, and they said that it was, going to just crater, absolutely crater. And, a bunch of these people on the forum were like, hey, that's not necessarily true. GameStop's been trying to improve their business model, and so basically, like, GameStop brought Nintendo of America's former president Reggie Fils-Aimé. He was the one that really brought the Wii U or the Wii to the forefront, and was like, he had a huge direction with Nintendo of Japan to like tell them, hey, you can't compete with Sony and Microsoft technology. You need to be innovative and make games more interactive for your fan bases. So he was the one that kind of pushed it. So he's a very innovative guy. They brought him on the board, and they also brought the guy that founded Chewy.com, which just IPO'd it was Pet Supplies Plus, I think it was, or PetSmart. It was PetSmart, sorry. They just bought Chewy and IPO'd this year, and sales have been through the roof because people are stuck at home. and they're stuck with, and there's been a huge increase in adoption of pets, during the pandemic. So people have companionship. So, that was like a big, stock market darling this year, was the Chewy IPO. So they brought this guy on. And so what these people on Wall Street Bets have said, hey, let's give GameStop a chance, because they are, they're actively trying to improve their business model. They know that, they have to change this up, because if they want to, survive as a company. So all these people started pouring in the bets. And so, when you short a stock, you're, like I said, when GameStop was at like $20 a share, these Wall Street hedge funds, all came in and was like, hey, this GameStop model is completely obsolete. It's completely crap. It's going the way of Blockbuster Video. So they started buying the stock at they started selling the stock at $20, predicting that it would crash to like $10, and then they could, make $10 differential. But then, so what happens is what they call a short squeeze. So all these Redditor, Wall Street Bet people on Reddit, and Robinhood, the Davey Day traders on Barstool, they all kind of band together.
Mm-hmm.
And so they started buying, GameStop stocks, and that pushed the price up. So when those hedge funds had already sold those shares at $20, when it starts going up to $20, $30, they're then liable to pay out at that price. And then that's where they incur losses, because they already sold that shares, and now they're $10 in the hole if it goes to 30, or they're $20 in the hole if it goes to 40. So then what they'll do to try to cover their losses is they start buying in this. They have to pile in and buy the stock to cover that short as quick as possible. So, if it starts busting up to like $24, they're in panic mode saying, hey, if this goes up to 30, we're going to be really screwed. So they start buying, which then drives the price up further, because now, in a short squeeze situation, when like you have a massive amount of people that pile on and buy a stock, it's almost kind of like a tug of war between Redditors and these hedge funds. So that tug of war, as it's going on, you do not, when there's a short squeeze as a hedge fund, you do not want to be the last guy to buy the stock, because that means you are taking the biggest loss. Okay. So then all these hedge funds then started turning on each other, saying, oh crap, for us to be good stewards of capital, we have to start buying the stock. So it just started pummeling through. And then some of these hedge funds, after that short squeeze broke through, and some of these retail Reddit, Robinhood and Reddit traders got out, they tried to then again put short that stock to recoup those losses that they initially took the first round, and then all these Redditors just piled on again and just punished them. So these hedge funds have been doing this for years.
Okay, quick question. You said they started selling the stock at around $20. What did it rise up to? Do you know?
Oh, at one point it was like $390. That was the last high I heard, but I mean, it could have went up into the 400s. I know from the last time I checked, it was right around like 200. So it's kind of bounced back down. And then like I said, and that's the biggest hypocrisy of this whole thing is, these hedge funds for the last decade.
Well, yeah, that's what I want to jump into real quick, is that when this really started popping off, I guess Robinhood had stopped people from buying or selling or something to that effect. And then what I found fascinating, some of the heads of the Wall Street type companies were actually on TV asking for, get this, more regulation.
Yeah. It's and that's the huge hypocrisy of this at all, especially since post 2008. These hedge funds have literally been, shorting these stocks. I mean, it's been happening probably since the 2000 on. With the .com bubble, I guess that's really where you start seeing the big shorting of the market. And so these short sellers, I mean, they've just pummeled companies into the ground. Most of these companies that they pummel into the ground, employ working class people that make, $10 to $15 of that per hour.
Now, can you walk us through real quick? Because I paid as much attention as I could, but it's out of my range of understanding. Can you walk us through how, okay, it raised up and then Robinhood started taking action. Can you tell us exactly what they were doing, implications that leads to the future of trading?
Yeah, so and this is a perfect segue to what will become like what is the post Robinhood future. There's going to be some kind of good scenario, different scenarios, and I'm hopeful. I like to consider myself an optimist. I'm hopeful that what's going to come next from this, because this is now exposing a huge revolution, and this whole kind of revolt against the establishment, and through all different sectors of the world right now. But necessarily what happened then is, so Robinhood, they say free trades, okay? And so people are like, okay, great, I don't have to pay a commission out for trading. They're taking some of that money, they take that money that you put in your Robinhood account. So let's explain real quick. I think it'd be good to kind of explain how Robinhood makes their money, by doing commission-free trades.
Absolutely.
Okay. So
what? Real quick, I had
okay.
signed up for a Robinhood account maybe last year, late last year, because they were giving away a free stock, and I could never link my bank account because I use a credit union, so I never got to invest any money. But I do have one Zynga Mobile Games stock, so we're in there.
Okay, there you go. So how Robinhood makes their money is they go in and they offer commission-free trades, so they don't make any money there. How they make money is, so say I take my I get like 3,000-4,000 back from my stock or from my tax refund, and I put my that money into my Robinhood account, okay, to trade on. So what they then can do is they can say, hey, they can go to like a financial institution and say, hey, I have 80 million people with the average of like $4,000 in the account. Can you lend me? Then they'll lend on that margin. So they'll take 80% of the total assets that they have in these accounts, and they'll get money lent to them at a very low interest rate from the bank, because they know that this money's in the market. The market gradually rises over time, so it's a more secure lending product. So that Robinhood then can go to like a JP Morgan Chase. I'm not exactly sure who Robinhood's like direct banker is, but just hypothetically, they go to like a JP Morgan Chase or a Goldman Sachs and say, hey, I have 8.2 billion, in accounts total, users. Could you lend me out like 6 billion of that? So like 80% of that. And then Robinhood takes that 6 billion that was lent from JP Morgan Chase, which is probably at an interest rate of like 2 or 3%, because that's a very secure debt. So then Robinhood will then take that money and they'll invest that 6 billion themselves in very secure assets that are just gaining. So they'll probably put some in like U.S. Treasuries, real estate investment trusts, things like that gradually grow over time. So they make money on that back end of that. But the number one way they actually make money, the biggest pot of money for Robinhood is the data collection. So what they do is they take all your data and like your trading history and all that, and they mine all that on all their users, and then they sell it to hedge funds. And the hedge funds then go ahead.
So they're not even like a stock company primarily. They're a data collection company that lets you sidebar and play with stocks a little bit.
Correct. And then they take that data and they sell. Yeah, and they take that data and they sell it to these huge Wall Street hedge funds. So Like, for instance, now this is where people are getting very, very angry, and they see that it's just blatant corruption now in the market. So Robinhood's biggest client on the data side happens to be Citadel Investments. Ken Griffin's his name. He just little bit of background about old Ken Griffin here. He just bought the most expensive house in London for like $182 million. Then he bought another penthouse, one of the most elite penthouses in all of New York City, for another 122 million on Billionaires Row.
God almighty.
So, and he,
Dave,
with
I
this
pay $550 a month. He does not know my struggle.
he does not know your struggle. And that's where this is where the outrage lies. This is where the outrage lies. So Ken Griffin owns Citadel. Citadel is the biggest data client from Robinhood. Now, here's where it gets fun. The reason why he was able to buy those houses is during COVID, when the shutdown first began in March, you saw a bunch of people take their $1,200 checks, and it was being advertised because they were saying, for instance, in like 242 years that our dollar's been in circulation, roughly, it's like 241, between 241 243, I forget exactly. Okay. In July of 2020, when the stimulus really went out to people, or was pretty much finalized with that and PPP and the $1,200 checks, we had printed more money in 1 month than we did in our entire 242-year circulation of the U.S. dollar. We circulated more money in 1 month.
Dave, the more I talk to you,
242.
The more I lose.
Years combined.
The more I lose faith in our financial system.
Yeah. And that's the problem, because we have, they're just printing money. So a bunch of these people that took their $1,200 could see what was going on, and they started putting money in Robinhood. And, and then I don't know, I'm sure you've heard of like El Presidente on Barstool, David Portnoy.
Yes.
Okay. So, with sports being shut down in March, there was nothing to gamble on, and he's a degenerate gambler. That's how Barstool actually came to rise. Is he started out literally as a betting newspaper around Boston, and then he turned it into a betting blog, and then it just blew up into this whole like entertainment thing. But he started out as a degenerate gambler. So
it is now.
Yeah. And so when with no sports to bet on, he was on Barstool telling all his like loyal, fan base that follows him for gambling advice and things like that. He was like, "Hey, we're going to start trading stocks. I'm Davey Day Trader guy." So he started doing hashtag DDTG, and it started catching on like wildfire. So you had all these like Barstool bros. They started, taking their $1,200 checks and putting it in Robinhood. Then you had the Wall Street Bets Redditors. They started all taking their $1,200. So then Robinhood blows up. And they get all this data on all these new people with all these $1,200 checks coming into the system. Then they took that data, sold it to Citadel, and Ken Griffin made $6.1 billion last year in 2020 alone, trading on the volatility with the data he got from Robinhood traders.
Wow. Must be nice.
Yeah. So here's where the outrage then goes. These Redditors who he basically wrote their backs on in 2020 and got he made $6.1 billion, bought $330 million in homes, on two different continents. So, he's living a pretty nice life, I would assume. He doesn't really have to worry about stuff in life. So all these, Redditors who are, working class, middle class guys and girls that are just trading. And if you read some of these stories on these Wall Street bets, it's amazing. One guy thanked the group. He's like, because of you guys and able to pump this GameStop stock, I'm now able to pay for my sister's Lyme disease treatments, or, I'm able to get my mom out of debt. You know, a lot of these guys, it's heartwarming. If you go on Wall Street Bets, I mean, it'll warm your heart because you're seeing all these guys that are, you know, they're living paycheck to paycheck, and now they've had, you know, been able to make some money and put away to, you know, be able to like take care of family and things like that, and pay, you know, get out of debt. And
You're giving me both ends right there, because at one point you're telling me about this guy who made $6.1 billion, and I'm like, wow, must be nice, blah, blah, blah. But then you're telling me about these people who like made money for their dying and sick relatives. And I'm like, wow, if I would have made money off Reddit, I'd have been like, hey, I was able to pay off my Aaron's furniture, guys.
Yeah. You know, exactly. But there's a bunch of stories like that for real. And, you know, so then, you know, here's the outrage. These hedge funds, you know, Melvin Capital is one of them. They lose like 3.1 billion shorting this GameStop stock, and these Redditors pushed it through and pummeled this. So then Citadel gives Melvin 1.1 billion. Melvin then tries to take that money like a crackhead that's out of money but is looking for another rock. They then go and take that 1.1 billion and they try to short the stock again and get pummeled. Now they're facing bankruptcy. So Citadel knows now that they're out of their 1.1 billion because Melvin just blew through that. And so Citadel then calls up Robinhood and says, you got to stop your people from trading a GameStop, and we got to stop this now. And they're outraged. And so
now, is that
GameStop,
legal? Is that legal?
Well, now there's going to be a huge amount of lawsuits, you know, because of it. And so Citadel went to the Securities and Exchange Commission on it. They went to NASDAQ, and they went to Robinhood and told them, you got to start halting this, and you can't do this because, you know, we're getting killed here. And, you know, hedge funds represent, you know, the 1%. You know, that's where their monies are in. You know, I mean, some, you know, like Warren Buffett had this bet with a hedge fund manager that he could put money in a Vanguard index fund and gain more of a rate of return over 10 years than the hedge fund, and he won that bet. So, you know, the hedge funds and private equity firms, they're really the parasites of capitalism. You know, I'm not a fan of them at all. And they've wrecked, you know, solid companies in the ground. Look, I mean, what they did to Sears. They literally, you know, one of the hedge fund managers, Eddie Lampert, this guy literally to this day has his own island outside of Miami in Florida with like security gates and a whole like private police force because he's like that worried about death threats for what he did. So he shorted years ago, he shorted Sears, and he shorted them pretty much to almost bankruptcy, and then bought the company last minute for pennies on the dollar. And then he took all the money that they were able to raise, and he started getting loans from all these banks to keep them in business. And he started paying himself huge money. He basically sacked Sears with billions of dollars of debt, paid himself the billions in executive compensation, and let the company just go into bankruptcy and just completely destroyed all its value. And now he's selling it off part by part for even more money.
See, they're playing
the pensioners.
They're playing games. They're playing games that I don't even know exist. You know what I mean?
Yeah.
Like, this is so far from a normal person.
Yeah, and it's essentially legalized. It's perfectly legal what he did, according to the rules. So he essentially just did legal embezzlement, you know, through manipulation in the markets. You know, and that's the problem. You know, with this modern capitalism, there needs to be certain reform in that. You shouldn't be able to destroy just companies overnight and profit billions, especially when the employees are working class to middle class jobs. That just increases the wealth gap. And, you know, the number we're going to go, you know, down the road here, we'll probably go into and segue into the number one driver of the wealth gap.
Well, Dave, I had you on an episode of What in the History with my co-host Dan Brady. Shout out to him. And we were talking about the Great Depression. And Yeah, it seems like there may be some mirroring instances here. Is there any way we could be going for a collapse?
Very well. There's some very interesting things that are going on here, with the markets and that. So, how the market got in. So back in the Great Depression, the problem is they restricted credit. And they restricted it, and it caused a banking crisis and a runnage on the money supply. So that's why you saw the bank runs, and that's why they shut down the banks and had those bank holidays to try to stop the chaos in the Great Depression. So they restricted the currency supply. So when everything happened in '08, Ben Bernanke, who was the Fed chairman, he said, we're not going to make that mistake that led to the Great Depression. We will print as much money as we need to be possible and circulate in the economy to make sure that we get out of it. So they started giving access to credit. They started lowering interest rates. We have near 0% interest rates. I mean, you can get a 30-year mortgage right now for under 3%. I mean, that's insane. In the early 80s, it was like 17.25% for a mortgage. Now it's under 3%.
Oh,
I mean,
wow.
that's insane. So they've pummeled, they've kept interest rates. They've killed savers. So, they've killed these savers. And so, what you're seeing now is you're seeing them, circulate. So from about 2010 to now, and it's still going on, and it doesn't matter what the political affiliation is. The Federal Reserve's controlling the money supply and the debt and the credit, and the ease of access. So they're basically saying, hey, we don't want to restrict it. We have to keep funneling it in to keep it going, because they're worried that if they pull the faucet and they pull back and they start rising interest rates and they start limiting the supply of money, there will be a depression. So now it's like it's like a drug addict. Essentially, they have to get their fix. And so to keep the economy somewhat appearing as fixed, even though there's so many fundamental problems underneath the surface, they're going to keep that faucet of money just flowing into the economy. And look, Biden's right now trying to pass a $2 trillion stimulus package because people need it. People generally need it. I'm not justifying, hey, we can't have stimulus. You need to get people some money, especially if you're trying to shut down the economy.
Check, Joe.
Yeah, you got to sign the checks. I mean, so I'm not sitting there, advocating for no stimulus, but that $2 trillion, that's being funneled in the economy. So the working class is going to get killed. The lower middle class is going to get killed, because you're going to start seeing 10 to 20% inflation in groceries and gas and things like that, and all these different expenses, because our dollar's less valuable. When you're circulating that amount of money at that low of interest rates, and the only thing that's really holding it up right now is our petrodollar, our deal with Saudi Arabia, where when Saudi Arabia sells oil, they sell it in US dollars. So that's like the only thing that's really holding this whole system up. But, you can't keep printing money. And that's why you're seeing stocks going up. The stock market's up, but there's 1 million people filing for unemployment per week right now. The stock market is not a reflection of the real economy.
I agree fully. Now, keep in mind, all my knowledge about the stock market comes from what I'm learning from you and Trading Places, the movie Trading Places. That being said, the last like financial crisis I really remember outside of this whole Reddit thing was Enron. And I've always wanted to know a little bit more about that. I saw the movie Fun with Dick and Jane. That was a hilarious romp that didn't explain anything financially. Can you explain how that happened? Because it feels like it's connected.
Yeah. So, here's the one thing that you could advocate for: short selling. Short selling, one of the best short sellers on the Wall Street, Jim Chanos, he actually shorted Enron. And that's what kind of blew open the whole whistle. So shorting stocks, there is a benefit to it. So we can go over that real quick. So like these short sellers will pull out, and they'll note fraud, and they'll call it out and they'll short the stock. So they're kind of like, they can act as a watchdog too for some of these shady dealings. Enron was one, Valiant Pharmaceuticals was another. So there is that, and that's actually how Enron got exposed. So what Enron was doing is they were basically doing, they changed up accounting models, and they basically put a gun to their accounting firm, Arthur Andersen's head, and said, "You're going to go agree with this, or we're going to find some accounting firm that will." And that was one of Arthur Andersen's biggest accounts. So they did whatever they were told by the client. So that like there's a whole set of ethics issues there. But then what they would do is they did a bunch of failed business deals. So what happened is in the 80s and 90s, you started seeing energy markets become deregulated, where people would bid on public utilities and they would take those over.
Now, was that thanks to Reagan? Did Reagan do a lot of that deregulation?
Yes, yeah. So that was part of it. It happened under Bush, and even Clinton deregulated a lot. Clinton's more of he deregulated a lot in the financial markets, where Bush and Reagan deregulated a lot in the energy markets. So what you see here is then you have, they deregulated. So like, these private companies then could bid out and they could sell energy to, California or these different cities and what have you. So then they would, Enron formed, through a merger from several different little entities around Houston, and they started doing this, across the country. They did it in India, and what they did is they over speculated. But what they did is to hide those losses, they set up other LLCs and they just funneled the money, the losses over there. So it wouldn't necessarily be on their financial report. So they fudged the numbers enough to look like, hey, we're not losing money. But on the backside, yeah, we over speculated and we're getting killed. And then, they were actually a huge reason, their shady business dealings. They were trying to get milk, California and, certain parts of India. Because India did similar deregulation. Enron bought up these, utilities operations in those in California and India, and in the early 2000s, California and India had huge issues with blackouts. That was actually caused by Enron.
Today's episode is brought to you by Tenacious Detail, your mobile detailing solutions in the Pittsburgh area. We know it's cold, it's rough. It's a rough time for everybody. You don't want to deal with anybody. You don't want to come in contact with COVID. That's why Tenacious Detail come to you. Get your car detailed in the comfort of your home or office. You don't even have to interact with the person. Just leave your keys in the car when we set up the date. Everything can be done through phone, email, text. Check us out at facebook.com/Tenacious Detail PGH, or give us a call at 724-498-9942.
Like in the late 90s.
Okay,
around 2000.
Quick question.
Yeah.
What did Enron actually do? Were they just an energy supply company? I know that seems very basic because we're so far removed.
Yeah, so they basically traded energy contracts. So they would, they were basically like a commodities brokerage house. And they would, they would buy everything from broadband. One of the things that they got killed on was actually buying water rights around Argentina, and then the Argentinian government and certain municipalities in Argentina defaulted, and they couldn't pay Enron, for the water, supply and the rates. And so there's all this, this back and forth. So they were basically acting like a commodities house and a utility operator. They would just buy the rights. So they would operate these different, entities that would control these, and then they would take the losses and just keep hiding them through different LLCs and shell companies. So that way they wouldn't necessarily reflect the books. And so they were able to fudge financial statements. And so people were getting, they kept buying the stock, but the company was essentially worth nothing because they over speculated, and they essentially just got, killed on their, a lot of their projects. So that's essentially what happened.
So what was the big tipping point? Like, was there a day when everything just went batshit at Enron?
Yeah, so there was, and actually it turned into a documentary film. There was a Wall Street Journal reporter based out of Dallas, and she would cover the energy markets. So like she would ask them questions about the performance, and the numbers would look bad. And so she would ask them questions, and like the CEO would like basically just treat her like complete shit, like degenerate, just like denigrate her, makes like sexist statements, things like that. Like she was a woman, she didn't know what, like what, she was talking about. She had no business like asking him, a master of the universe, a Harvard MBA, these type of questions. He knows what he's doing, kind of thing. And it got really ugly. So that started turning people off. And then Jim Chanos, that short seller, he started shorting the stock, and he was going on CNBC and what have you, and writing op-eds in like the Wall Street Journal saying, hey, these numbers don't make sense. What are all these? They called them Raptors. They were like LLCs and limited partnership funds that they were funneling all the losses into, and they set it up through so many different shell companies and different LLCs to make it not reflect that it was actually Enron. And so Jim Chanos said, we need to look into this. And then so between the Wall Street Journal and Jim Chanos, they were able then to kind of follow these LLCs and follow the money, to speak. And then they basically showed that Enron was essentially worth nothing. The emperor had no clothes at that point. And so then the money, the company completely crumbled. The stock went to $1, and it was nothing. So that is an actual instance where a short seller actually did a good deed and was a watchdog in the market, and tried to protect more people from getting defrauded.
Now, when that happened, was it a big deal just because it was? Was it a big deal just because it was a huge company and had a lot of people invested?
Yeah, it was a huge deal and it started the Sarbanes-Oxley. Because Enron was the first one. There was another company out of Mississippi, MCI WorldCom, that did something similar, and those executives went to prison, and so you saw them. There was another company called Global Crossing. There were several companies, I think up to as many as 12, that were publicly traded and that kept fudging numbers. And basically they passed Sarbanes-Oxley that basically said that a CEO has to sign off on his company's financial statements. And if he wants to hire an independent board of his own auditors to look at it before he certifies, then he should do that. Because now, if you're a CEO of a company, when you sign off on the financial statements, you're personally held liable. So if they were committing fraud, or they are fudging numbers, and you can't really play dumb, you're held accountable now, and you can face prison time and things like that. So that was like one of the things that really came about that. But it wasn't just Enron. There was several companies. There was Adelphia, up by like Dan Brady over there in Coudersport, like in the northern tier of Pennsylvania, small town. There was a cable company operator. They became one of the largest cable operators in the country, and they were committing fraud and kind of fudging their numbers. And a bunch of those guys went to prison and things like that. So Adelphia Cable was another one of them. But yeah,
so did that lead the way to exposing more companies for these fraudulent activities? And it seems like it's something now that can be done at a smaller scale, but have they prevented it at a larger scale?
Yeah, well, like The Big Short, in 2008, there's a movie with the guy from The Office, Steve Carell, and then it's got Christian Bale in it. they basically, those guys like shorted the mortgage companies in the financial sector. They knew that the mortgage collapse was going to happen. So they ended up shorting the more, Countrywide and some of these banks that were heavily involved. And, they made billions of dollars shorting those companies because they knew that they were committing, there was a lot of fraudulent mortgage activity going on in the banking sector.
Was the mortgage shortage or whatever that was, and like the collapse of Enron and those other companies and the .com bubble, was that around all the same time, or were they connected to each other?
They weren't necessarily connected. So there was a huge list of impacts there because in the 90s we had a huge run there. The economy was booming in the 90s there, and then we had the .com bubble that cratered because there was a lot of companies that just weren't even making money, and they got exposed, and they so that kind of collapsed, and then you saw you had that collapse. Then you had these companies. So then you had these companies that were committing the accounting fraud, and then that actually the Enron scandal then too also led to the collapse of one of the largest accounting firms in the country, Arthur Andersen. So there was that collapse due to the Enron scandal, and then you also had 9/11, and 9/11 bankrupted several airlines after that because people were just too leery about riding a plane. So the airline stocks, and then when they shut down several days from operating after the attacks, you saw like a whirlwind there. So to get the economy up, necessarily get the economy back to bouncing, they started trying to expand ease of credit into the markets. So that was a directive under the Bush administration is, hey, we need to get the economy stimulated. We need to ease access. So then like they told Fannie and Freddie Mae Fannie Mae and Freddie Mac, you have to essentially then, you need to lighten up your regulatory and underwriting standards on some of these mortgages. So then they were giving ease of mortgages because they wanted to kind of spur to get out of the sludge of the Enron scandal, 9/11 killing airplane stocks and the .com crashing. They tried to bolster it through the actual housing, and try to build out home building. So then they basically, rates were around, 5-6%. I've seen them up to as high as 8% back then. But anybody could get a loan. We're actually doing, and how the largest bank at the time in Cleveland here was called National City Bank. It was one of the first banks that actually banked Rockefeller. And that's how they kind of came to fame. So National City, they were notorious in this area because at the time I was actually working as an intern in one of the divisions at Citigroup called Primerica. I was selling insurance and things like that. I was working like part-time in college doing that. So I was selling insurance. I was doing refinancing and mortgages and things like that. I had my license to operate in Ohio and all that. I was 20 years old. So I was working at the Citigroup affiliate, and we were getting calls, from the office, not me personally, really, but it was, it was talked about in the office. So National City, what they would do is they were giving what they called ninja loans. So that stood for no income, no job or asset declaration. So you would just be like, yeah, I'm a landscaper, and they might get paid in cash and not claim anything on their taxes, and they could be like, yeah, but I make this much money. And National City actually was giving them interest-only loans, balloon loans is what they were called. So essentially, like there was one guy who tried to get a refinance through, Primerica and through Citibank. He was like a landscaper in Medina, which is a nice, really, really nice suburb of Cleveland, about 35 minutes out. And actually, Medina used to be like a rural backwoods. And because of all the ease of access, there was a huge housing boom, building boom in Medina County. A lot of people from Cuyahoga County started migrating down into Medina County because of all these housing developments were being built on easy credit, So one of the guys that bought one of these houses, one of these nice developers, I'm talking this house was probably a $600,000 house. The dude was a landscaper making $70,000 a year, and he's living in a $475,000 McMansion in a nice housing development in Medina. So he comes to me, or well, that doesn't come to me actually, comes to somebody I know in my firm, and he goes, I need to refinance my loan. I'm with National City. So National City gave him a loan at like 4%, interest only. So basically he basically put very little money down. I think he might have put the $5,000. So it was a $470,000 loan. Bought the house with $5,000 down, $470,000 house. And it had, so he was paying 4% interest only. So his monthly mortgage payment, he was only paying the interest on that $400,000. He was not paying anything to the principal. So there was like it was a 5-year period and then a balloon only. So they were like, oh, by the time, what you need to do is we'll give you the money. You get your money like claimed on, you get your income actually claimed on taxes and things like that. Then a more traditional financing vehicle will be available. You can refinance by that time. So that's what they told him. So they get to hit, this, and it's a 400. So he's paying the interest on it. The last payment that was going to come due was for $475,000. So he either had to refinance or cut a check for $475,000 for the whole house. Yeah.
Oh, so that's intense.
So for the whole time of the 5 years, he's just only paying interest on that. So it's like a credit card. Yeah, and you're just paying the interest on it. You're actually not paying the balance. And
I imagine a lot of people signed these and got duped without thinking about them or not financially literate and signed up for these loans.
And so what ended up happening, National City collapsed because of that. They went under because they were one of the largest lenders in this category. And so PNC Bank actually, through a shotgun marriage with the Federal Reserve gave PNC all the money at a low interest rate to buy the assets out of National City. So there's no more National City Bank. It's all PNC now. And PNC got them for pennies on the dollar because they over-speculated in those ninja loans. And it's
you seem to be a man that knows a lot about the finances. So let's shift for a moment and let's go into Bitcoin. From what I understand, you know a bit about Bitcoin. Can you break that down for us?
Yeah, for full disclosure, I am a Bitcoin investor. I do own Bitcoin. And so what you're basically seeing here is now you're going to see the revolution. After all this stuff here, you're seeing people are now waking up to the fact that there's too much control in the stock market. There's too much control in the economy and power, and everything's being centralized. So, and then two, you're having the trillions of dollars being circulated into the economy. And when you do that, now you have an instance where, our dollars are becoming worth less and less every day. So now there's the hunt for the inflation hedge because inflation's here. If you've been to the grocery store the last couple of weeks, you'll notice there's a steady incline in prices. And that's why gas is still at $2 to $3, between $2 and $3 a gallon, because they keep printing and printing money. So that now you're seeing why Bitcoin is essentially like digital gold. And so what it is there's only 24 million Bitcoin in the market. Now, what's crazy about it is like Bitcoin was like the Wild West, at first. People were using it to buy drugs online, using it for like Silk Road and things like that, or like, unfortunately, and very seedy stuff like child pornography was being bought with Bitcoin. So, a lot of the federal government did come in and they, the federal government actually allocated a bunch of money early on and they brought in top computer scientists who actually were able to infiltrate some of these networks of child pedophilia, of the drug markets like Silk
Good.
Road and Alpha
Good.
Market and things like that. Yeah, great stuff. But the thing that happened because of this, 20% of the Bitcoins in circulation are now actually locked out of the system. So that's actually created more scarcity. And I
Oh.
think it's great. I think it's great what they did. I'm just trying to explain what's happening too. So now you have even 20% more scarcity because of the shady stuff that was going on early on with Bitcoin, or things getting stolen, or people like that one guy, he has 229 million in Bitcoin and he doesn't remember his password to his hard wallet, or his cold wallet, his cold storage.
Let me stop you.
Those things.
Let me stop
Yeah.
you there. Okay, so I was talking to a friend about this the other day, and I guess that guy has like 2 chances left to figure out his password, or he loses it. Or now, where
Yeah.
does it go if he loses it, and does it ever transfer to anyone after it's in the ether?
No, that's the thing. And so now we're seeing like 20% of the Bitcoin that's currently in circulation has been locked out due to federal government busting sickos on the internet, on the dark web that are doing, dirty shit. They're getting, so the feds have some of that. And if they're able to recover any of that Bitcoin, some of it that, once they bust these, pedophiles or drug dealers that are circulating stuff on the dark web, some of those people, they hide their cold wallet storage, and they could put it in a safe in an offshore, banking entity or something like that, where, they're going to prison and they know, hey, if I get out, when I get out, or if I get out, like Ross Ulbricht, who was the guy behind the road, he's in prison for life. But there's other ones that are serving time. They might put their stuff in a cold storage unit or a cold wallet and, keep it, tucked away until they get out. And then they're like, hey, I got all this money in Bitcoin that I can live on, so you have some of that, some drug dealers, things like that. Yeah.
Let's pump the brakes a little bit, and let's go back to a more elementary level of this. So I don't know what the term cold wallet means. Let's say someone who knows nothing about Bitcoin, say I want to buy some Bitcoin. How do I go about it? Where is it stored? All that stuff.
Okay, so there's 2 types of ways to get Bitcoin. Well, there's multiple ways, but there's 2 types of storage for Bitcoin. So there are cold wallets and hot wallets. So like if you sign up for Coinbase, or get Bitcoin through Cash App or Robinhood, if you wanted to do that. Now there's a Robinhood revolt. People are pulling their money out of it, yada, yada, yada. But excuse me. So say you wanted to get your money, like the easy way to invest in Bitcoin would be set up some money through Coinbase or something like that. And that would be called a hot wallet, meaning like it's a fully online. I trust Coinbase to be a securator of that money. They're the most established exchange on the market. That's what you would call your hot wallet. Your cold wallet is like, so it's like this big. Here, like getting the camera here. Sorry, it's like this big. It looks like a mini USB disc kind of thing. It's a little bit bigger, or those things, those like little battery packs that you plug your phone in to charge if you're like not near like a charger, but like you have like an extra battery pack. It kind of looks like those. So what a lot of people did, and especially early on, because there wasn't like a lot of exchanges available where you could just buy and sell Bitcoin very easily, you ended up buying these devices called cold wallets, and then you would plug it in through your USB port into your like laptop or computer, and then you would move all your Bitcoin into that, and then you would keep that. And there's some as small as that would fit on a keychain. So people would keep it on like on a keychain or a necklace, or they would move it into a safe, in a different bank or, something far away. I know people that, move them, they have it in a bank in a different state, and that way, if, the people know that they have it, they can say, hey, like it's 1,000 miles away from me. I don't even have access to it. What do you want to do? Things like that. So like the thing is like the cold wallet would be considered more like secure. Like that's the most secure way to do it, because like they're password protected and you actually hold the Bitcoin in your hand, like physically. That's how you would hold it. It's like on one of these devices. So you have that, and then you have like the setup. Like with me, I hold mine at Coinbase, because I know Coinbase is like the most like regulated, and like they're actually going to be listing on the stock market this year. So they are actually a company that is trying to get Bitcoin more into the mainstream. It was just the easiest of use for like an honest like me, because like I don't own a full Bitcoin. I'm not that wealthy or anything like that, but like I own a little bit of it because I see the investment in that, and I allocated 10% of my investment portfolio towards it. And, because if something happens where Bitcoin would go under, I don't see that happening, but there is always the what if, say Satoshi Nakamoto,
Yeah.
the mystery guy behind Bitcoin, or mysterious group behind Bitcoin, turns out to be part of the Chinese Communist Party or something, and then they nationalize all the mining networks that mine the stuff. Something like that. I don't see that. That's like that'd be a crazy one-off scenario. But if Bitcoin drops down to $1 or $0, and I lose all that, I'm not going to sleep I'm going to still be able to sleep at night without any worries or anything like that. And that's what I usually tell people: if you want to invest in it, like just invest enough that if it does go belly, because it is high risk. I'm not going to lie. There are, but I think that I have conviction that it's going to go up, and that's why I'm a believer in it. The fundamentals makes too much sense to me, on the surface. So I'm a firm believer, but like I tell anybody that always comes up to me and is like, hey, should I get into Bitcoin? I'll be like, and just only invest enough that where if you do lose your money, it is a gamble. And if you do lose your money and you're okay with that, then that's what the amount you should put in. If no more than that, you know.
Okay. What's you said Bitcoin is kind of like digital gold. What's your thoughts on physical silver?
Well, that's the thing right now too. What the Wall Street Bets crowd, that crowd, they're trying to do a silver squeeze right now. Gold's around, or silver's around $25 an ounce. They want to push it to 1,000. So I would buy silver. If you want to try to diversify, I'm actually looking into it to myself. So full disclosure there, because here's the thing: worst case scenario, because of the way that the market is going right now, with them printing out all this money, the Federal Reserve, and this whole quantitative easing on steroids that they're doing, they're going. The worst case scenario for silver is it's going to go up regardless. It just depends on how fast and when that happens. Over time, if they keep circulating the amount of currency that they're circulating into the financial system, you're going to see silver go up, in the long term. If the Wall Street Bets crowd then pulls on this silver and really squeezes it and pushes it to 1,000, best case scenario, you're sitting really pretty at $25 if you buy in at $25 an ounce and it goes to $1,000. I mean, that's a great return on investment.
Quick question, Dave. And I don't know if you're comfortable answering this, but where do you buy your silver from? Do you buy it from a physical location, or you buy it online? Do they ship it to you?
Well, I mean, there's three ways of buying it. You can buy physical silver online and they can ship it to you. I don't really have a necessarily like company that I prefer, like, or anything like that. When I buy silver, I usually go to like, in Ohio here, we have Hartville Hardware, and I'll buy silver coins, like I'll buy silver eagles, things like that. Like I prefer physical, the physical currency, having it there. Especially since I'm diversified in cryptocurrency. Full disclosure, I own Ethereum, I own Chainlink, and I own Bitcoin. Now, besides those digital, say a nuclear explosion goes off, or there's something with something crazy, I'm not predicting that's going to happen or anything like that, but you always keep those thoughts in the back of your mind. So say the power grid goes down or something like that, that we're not able to trade. I know my Bitcoin and those investments are secure, but I may not be able to necessarily get into those. Say there's a solar flare that wipes out all of our internet data in our area. That does happen. That is a very real threat. I know my crypto's safe, but I can't necessarily move or sell that in a physical world. So, silver to me, I'd like to keep physical silver. So yeah, you can buy that. Like Hartville Hardware is like a big silver dealer in like my local area. But you can go to pawn shops and buy silver. You go to metal exchanges and buy like rough silver for
Okay.
a little bit cheaper. So you could own physical. You could buy. Oh, go ahead.
I'm not putting you on the spot here, and no one is to take this advice to try and get rich. And if you lose your shit, blame Dave. Go fuck yourselves. But when you
full
say
disclosure, I'm not a financial advisor.
When they want to push silver to $1,000 an ounce, when do you predict that to be buy? Because I'd like to buy some silver this week.
Well, I mean, if you just check on Wall Street Bets, I mean, that's what they're saying. And if you look at like finance Twitter, if you follow like the Winklevi, Cameron and Tyler Winklevoss, who founded Facebook, they're now they might go down in history as some of the greatest investors of all time. To be honest with you, they were ones that helped found Facebook. They sued Mark Zuckerberg because he kind of like stole their idea and ran with it. So they were able to sue and to get $1 billion stakes in Facebook. And when they sold those stakes when Facebook IPO'd to give it back to Mark, but they got their payout. So what ended up happening is they took that money and they started buying Bitcoin when it was really cheap, and they've more than 10x their money. Let's just say that, and now they own an exchange. So they own like their own Coinbase. It's called Gemini, since they're twins. So that was kind of like their play.
Cool.
But you could just like follow Wall Street Bets, I guess, and see with me personally, like silver, the worst case scenario to me is with the money printing that's going on by the Federal Reserve, it's going to go up regardless. It just depends on how much, and if it does skyrocket through this, if Wall Street Bets does get a hold of it, are they going to rise? So you can buy silver physically. You can buy gold online or gold or silver online. I can ship it to you, or you can buy contracts like a stock, kind of like a stock option or something like that. You can actually buy it on the market.
I have a question for brokers.
Yeah.
Say I have 20 ounces of silver. Say I bought 20 ounces of silver at $25 a pound, and then one morning I wake up and see, holy shit, it's at $1,000 an ounce. Am I stupid for running out and selling it?
No, I mean, I necessarily wouldn't think, because, with everything, there's going to be like a crash, there's going to be a rise and there's going to be a fall. And, even with like GameStop, it's going to come down eventually. It's not, GameStop is not a $10 billion company, so it's going to come down eventually. You gotta cut your losses, you got to cut your losses, or you got to cut it and get yourself some profit. So yeah, if it went to $1,000, I mean, I would sell, because it's going to drop, and then you can buy it down. You can buy it at a lower price.
Now I look at you as just a wealth of knowledge of all things banking and financial. That being said, I want to ask you about something that I don't really know a lot about, but I've always heard about in like movies and rich people. Offshore banking. What's that about? What's the benefits of it? How does it work?
So necessarily offshore banking is not even illegal. So basically what it is that there are, you can start putting your money in like offshore centers and buy like LLCs and that and pay taxes. So tax evasion is illegal. Tax avoidance isn't. There's a fine line between the two. So what a lot of these companies and wealthy people do is they then they'll set up like companies. So like Ireland has a flat rate. They have a flat rate, and like their corporate taxes are some of the lowest in the country, in the world. So what like Apple and Google and like a lot of these companies will do is, Apple and Google are notorious for this. But what they'll do is they will then buy or they'll basically set up or buy LLCs in Ireland or S corps in Ireland, and then they will basically put all their profits in there, and then they'll keep all their revenue into that, and then they're taxed at that rate. And then when they have to fund operations here in the U.S., that's when they will repatriate it. Then they'll claim that money back in the U.S. and pay a little bit higher. But they're paying, so if they're, say it costs, their revenue they bring in is $5 billion a quarter, okay, but then it costs $2 billion a quarter, and like these are just layman's terms. Like these numbers are way higher, I'm sure, especially with your bigger tech firms. But say you bring in like $5 billion a quarter, but it costs $3 billion to fund your operation expenses in the U.S. Then you repatriate that $3 billion, and you claim that on your U.S. taxes, and then you pay tax on that. So then you got that $2 billion just sitting there in revenue in Ireland, and you're paying a way less rate on that. So that's kind of like breaks it down on that. And then basically what happened then with a lot of this, you'll see like Panama was notorious for offshore banking and things like that. So like Boston George Young, from the movie Blow, Johnny Depp. So like he had a bunch of S corps in Panama, and he sent he had 140 million, or he had like 140 million in a bank account when he went to federal prison in Panama. It might have been him or a mobster. I'm now kind of losing my track. It might have been Michael Francese, who was in the Gambino crime family, or he's in one of the current 5 families in
the
New
fucking
York.
Snitch. We gotta
we gotta
call
him.
a spade, the fucking snitch.
No, Francese wasn't a snitch. He was the one that was running the gas. He was running the gas tax fraud. And he was one of the wealthiest mobsters.
Came out. He was a fucking snitch, brother. He came out. He's been doing Vlad TV interviews and other interviews. He's a fucking rat. Fuck him.
Well, anyways, he had like 140 million in the account in Panama, and when the U.S. government went down and took out Noriega, they took the 140 million. So it was notorious. Panama's always been notorious, but there was one firm there, Mossack Fonseca. Mossack Fonseca was the name, and they were a law firm that specialized in setting up offshore LLCs and things like that. So like a lot of these companies would set up, a lot of these billionaires would then send money offshore. And then like there was another crisis so that was called the Panama Papers. Then there was another one that came out a couple months after that called the Paradise Papers, and that was more involved in like what was going on in England, with like the UK. So like in 79, the pound, there was pound crisis in the UK. The UK basically was like facing a default in 79. To try to rebalance their economy, they joined the EU, and then they built London as like a banking hub, for the European market. And then what they ended up doing is they then set up like all these little islands. So like the Cayman Islands, Bermuda, the Bahamas, all these then became like offshore entities. Like there's the little islands in the Channel Islands and like the Isle of Man, like Guernsey and Jersey. These little islands between France and England, the south coast of England, are like offshore banking hubs. So like companies will set up things like there. So like that, the British have their own version of it, and that was exposed in the Paradise Papers, and you see it with like the Panama Papers. And the U.S. government's been retroactive on it because they want to cut. They kind of want to cut of like what's going on with this, because like U.S. real estate, especially like luxury real estate, is now like the new Swiss bank account. So. Little sidebar story real quick.
What does that mean?
So, essentially a little sidebar story. I'll explain that. So I went out, I was working on a project when I was a consultant, and I was out in LA. working for an undisclosed bank. I can't, divulge any clients I've ever represented, but they,
Right on.
so they, I go out to LA for 4 months and we're working this, and I'm staying at the DoubleTree. I go, and across the DoubleTree, there's this beautiful, brand new luxury a high-rise condo built. And I'm talking probably $750,000 a condo, especially in LA with that view. You got a view of the San Gabriel Mountains. I mean, absolutely gorgeous. And it lay dark every night. I would look out my window and say, wow, like that's a beautiful condo building. Like genuinely, I thought, wow, like that would be like, I'll never want to live in like LA, but like if I had to, gun to my head, and I had the money, I would live in something like that. I mean, it was absolutely gorgeous, and the gorgeous view of the mountain tops and all that. But it lay dark most nights, and I'm thinking, that's weird. And so it dawned on me, because, I've read articles about it and I've seen it. A lot of the wealthy, like Chinese and people from the Middle East, and that, they'll buy. So what they'll do, if they're oligarchs and they got some like illicit gains, they'll try to launder it through U.S. real estate. They'll buy buildings and just leave it sit. So they'll buy a condo. They'll buy a $750,000 condo, knowing that money's being printed into the economy with quantitative easing, and the Federal Reserve just keeps, throwing trillions into the economy. That's an asset. So they know, even over time, they'll take $750,000, buy a luxury condo in suburban LA, and they'll park that, and it'll sit dark and what have you, or they'll Airbnb it out in the meantime and things like that. And so what they'll do is they'll do that, and then they essentially, down the road, if they need the money, they'll sell it and they'll make a profit. And so, and then that way, like there's three phases. Yeah, so there's three phases of money laundering. There's placement, layering, and integration. Placement's where you take the legal dollars and you put it into the circulation of the economy. So you put it in a bank account, you put it in real estate, you put it in a bank account to buy you put it in a bank account, and you get that through, or an offshore entity, and then you send it through wires into U.S. banks. Then there's the layering, which is then taking that money to buy the real estate, like buy one of those luxury condos. Then the integration part, or the layering part, is you buy that condo and you let it sit for several months or years. And then the integration part is you sell it then to some other wealthy person, and the profits you take, you can say, hey, you can go to another bank and say, hey, I sold this house, I'd like to open my account. And they have no idea that the money came from dirty sources in the very beginning, because you've placed, you've done the three different stages of money laundering. So a lot of international people will buy U.S. real estate this way as a vehicle to hide their illicit gains.
Good Lord. Well, Dave, that is a lot of information. This is a little bit different of an episode than we normally have, but I hope you guys all learned something. I thought it was fascinating, man. Thank you so much for coming on.
Yeah, if you want to, if you real quick, we can just talk about like what's going to happen post Robinhood. If you want to do that real quick, I can go into that.
Yeah, absolutely.
So you're seeing a need. Yeah, so now there's this Robinhood revolt. You're going to see a need now for, and I want to talk about this because this is important, because now you're going to see a revolution. Now people are saying we need decentralization. We can't let Wall Street control a trading app that's going to, tell us when we can and can't trade stocks. So there's going to be with the Ethereum blockchain, think of Ethereum as like Amazon cloud computing that's decentralized. So everybody that has things on the network and stakes it gets paid in Ethereum, and they keep the network up without having to have like huge servers. So once decentralization happens, you're going to start seeing decentralized stock trading platforms. And like Mark Cuban was just on Twitter, he said that, he's waiting for the day that there's a decentralized exchange that can't restrict what you can and can't buy as far as the stock market. It'll be still regulated to fit the exchanges, what they want. But then, like if you do decide to like allow your stocks that you own to be shorted to a hedge fund, those brokerages also make money on those shorts. So they lend the money out because the hedge fund. So like when the hedge fund goes up and says, I want to short a stock, they'll sell it at that $20 a share. Well, the brokerage actually puts that money up front. The hedge fund doesn't pay it. They only pay the broker then when it goes to 16 or 15, and that's when they activate, hey, we're going to buy the stock then at 15, and that yield spread. So that's where the brokerage gets their money. So they actually do the selling on behalf of the hedge fund. So in the future, you're basically, so when you short a stock, you're essentially lending out your shares. Like, so when a hedge fund shorts your stock, they're essentially lending out your shares on the market and trying to make a money. So in a decentralized future, those brokerages will then pay the user. So if you say you own GameStop stock, a hedge fund then wants to short that, Johnny, what they'll end up doing is that hedge fund then will pay you some of the interest back on that, and those decentralized platforms will split part of that. So that's what Mark Cuban's saying, like he's going to talk about. So I'm hoping that what will happen is the people will pull their money out of the stock market, focus more on a decentralized future with like cryptocurrencies and other projects that are going on in that space. And you're going to see basically two financial systems emerge: the old system that's manipulated, corrupt, centralized, and you're going to see a new decentralized system that will give these small-time guys and retail traders a chance to essentially be a stakeholder in the system, and it'll be a more fair system. That's the overall hope, and that's why I'm hopeful and I'm optimistic about the future. I'm hoping it's going to eventually go that way. So I'll leave it on a positive note.
All right. Well, that's a great way to leave it. Like I said, guys, thanks for tuning in. Very fascinating. I was so excited about this episode, not only because I love hearing you talk about the financial logistics that I can't even grasp, but on top of that, we're super relevant this week. We're bringing relevant info to the people.
Yeah, thanks. And,
so
I'd be happy to come on anytime.
I genuinely appreciate it. You're not an entertainer, and I normally ask people to promo themselves, but is there anything you'd like to say to the people before we sign off?
If you want, send me a friend request or follow me on like Instagram or Twitter. I'm going to start posting more threads on Twitter, and it's DRS Jr 4506, I think, is my handle. I don't even know. I'm more newer to it. My wife's finally budged me into getting Twitter. So I've been a little bit out of it, but I'm going to start posting more stuff and maybe doing some more threads about economics and try to work on my way of simplifying it. That's like my goal, because like I know I'm more like scatterbrained when I talk about this stuff. So I'm trying to use Twitter as a way to necessarily like simplify things at more of an easier basis. So yeah, just try to follow me on social media or send me a friend request more on Facebook. And then once I start doing more stuff on Twitter, I'll, post my handle there and, on Facebook and things like that. And, follow me and, I'll try to break that things down and share things that I think are pertinent to the economy.
Sounds good, brother. Again, appreciate you. Hey, make sure you check out this week's episode of What in the History, where me and Dan Brady talked about Boudica, the Warrior Queen. You check out the merch store, guys. We got some dope shirts up. I'll be getting pictures of those soon. They're up in the store. Link will be in the description, though. Again, thank you to Dave. Thank you all that listened. Peace and love, everybody.
Thank you.